This is a podcast from the Business Times.
After the Federal Reserve cut its benchmark interest rate in mid-September, investors wasted no time getting into some of the riskier assets like tech stocks. And analysts are saying that tech stocks will move higher to the end of the year and through 2025. Others, though, have turned bearish on tech stocks. So what gives? Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim. And if you have feedback or an idea for a podcast episode, do get in touch, btpodcasts@sph.com.sg. Helping us out today, Dom Rizzo, Portfolio Manager, Global Technology Equity Strategy at Rowe Price.
Thanks for having me. It's great to be here.
So what exactly has been happening to tech stocks, and should we be concerned?
If we look at this year in review, there's really been one thing driving the bus in tech, and that's artificial intelligence. NVIDIA, for example, stock has gone up manyfold. And rewind to the beginning of the year. The global technology universe was kind of trading at a high teens multiple if you looked out 2 years. Most of the companies had mediocre fundamentals outside of NVIDIA. And there were some questions around what does artificial intelligence return on investment look like for the major hyperscalers? Since then, we've seen these stocks kind of re-rate to 23, 24 times earnings for the whole universe. Now, they historically peak at 26 to 28 times earnings, so we're in a relatively reasonable range. We're starting to see signs of life in the technology sector outside of NVIDIA. PCs are starting to get a little bit better. Smartphones are starting to get a little bit better. I think industrials is a couple quarters away from getting a little bit better. And then most importantly, we learned from the hyperscalers that they plan on spending a lot of money on CapEx. Our internal capital expenditure forecast has gone up almost 100% this year in terms of how much these major Super 7 companies are spending. And right now, a lot of those CapEx dollars are going into NVIDIA GPUs. But over time, that will spread out a bit as well. And so when I look at the global technology universe from today, I actually feel pretty positive. We just saw interest rates get cut. That's going to lower the barrier to investment for the hyperscalers. It's going to bring down the overall cost of capital. We're seeing high return on investment in this AI spend. The universe outside of NVIDIA is starting to accelerate. We should have a pretty nice fundamental setup going forward.
So when we talk about tech stocks, we have to take a step back and also help us define technology really and tech stocks as a result, because it's not just the Magnificent Seven.
So I kind of look in 4 different subsectors when I think about tech. There's hardware, semiconductors, networking equipment, phones, PCs. There's software, of course, all traditional enterprise software. There's the internet companies, and that's kind of a broad definition. You know, a lot of the Mag 7 fall into that. But if you look at the subsectors, that could be either communication services or consumer discretionary, even though they're not technically IT. And then finally, there's payments. And then we try to generate value in hardware, software, internet payments, small cap, mid cap, large cap, mega cap, the Americas, Europe, and Asia. So really a go anywhere global technology strategy that addresses the 4 main subsectors of technology. Now, the Magnificent Seven are really important, though. I think everyone tries to go outside of them. But because of aggregator economics, where if you control the demand, you can commodify the supply, the Magnificent Seven get better as they get bigger, broadly speaking. And that's why they've become such a big part of the overall investment universe, not just for technology investors, but for every investor in the world. And so you have to have a view and a framework for navigating those 7 stocks. And then, of course, you have to be able to look outside those 493 for additional opportunities.
What's the outlook then? Would it be different for the sectors? Would it be different for geography? Would it be different for what's going on for the next 8 to 24? I'm just thinking about where I should put my money.
Yeah, absolutely. First off, technology broadly defined is a good place to be. Interest rates coming down, fundamentals are accelerating. There's a strong setup on a broad basis. I always try to balance between those things: hardware, software, internet payments, mega cap, and small cap. If I look at the Mag 7, I actually think the fundamental setup on them is pretty good. They trade at roughly a 50% premium to the overall market if you look at a simple PE metric. but they've historically grown their earnings anywhere to 50 to 100% faster than the rest of the market. And so if you look at a PE to growth rate adjusted basis, they're actually fairly reasonable. Now, if we look at next year's earnings, though, why we're starting to see this market broaden out, and we'll use the 493 as an example, but this can apply to most global technology universe, is that the other stocks are starting to see accelerating EPS growth next year. While the Magnificent Seven, because they've had such a good 2024, will likely see decelerating EPS growth. And so I think you could pick your spots within the Magnificent Seven and try to figure out what makes sense. But when I look at the overall universe, I say, okay, there's some really interesting opportunities in digital semiconductors and enterprise software. And there's some really interesting opportunities in payments. And you got to be able to adjust and navigate for all of those.
What about regular folk? And how is the continuing advancement of AI going to affect the tech sector? Isn't it a big energy guzzler? More with Dom Rizzo from Rowe Price in a moment.
If you've been a fan of the podcast Mark to Market, Wealth BT and Property BT, they are moving to a new listing, BT Correspondence. Look for episodes every Tuesday from October. All the insights and analysis and market trends, property, wealth, and soon mobility too. Powered by the Business Times journalism of Genevieve Kwa, Leslie Yee, Ben Paul, and Darren Wong. Because great reads should be heard. The BT Correspondence channel. Find BT Correspondence wherever you listen to podcasts.
And now, back to Money Hacks from the Business Times.
Dom Rizzo is Portfolio Manager, Global Technology Equity Strategy at Rowe Price, giving us the skinny on tech stocks today and their outlook for the next 18 to 24 months. How often should we be keeping an eye on it?
Yeah,
please don't tell me every day, man. Where's the time for that?
No, of course. The way that I think about my strategy is it's an 18 to 24 month horizon. And the way you have great long-term compounded returns is to have solid performance in every 18 to 24 month period, regardless of economic environment, or at least try to do that. You really need to try to compound on 18 to 24 month basis to get very strong long-term performance.
See, your job is working for somebody who has deep pockets, but what about for the retail investor, really? Some of these stocks are quite price prohibitive. What do you suggest?
Yeah. If you look at who our client base is primarily, you said deep pockets. Our main business is actually U.S. retirement. And so we're working for everybody. What I love about our firm is that if I do well, everyone can do well. You need to have an investment framework to navigate different market environments, because if you have that investment framework, you should be able to help people compound over time. Number one, do your homework. I'm a big fan of Peter Lynch, and he said people often spend more time focusing on which refrigerator to buy than which stock to buy, even though the stock is your retirement. I think that's a really good way to think about it. Number two, have an investment framework. So for us, that's four things. We're looking for what I call linchpin technologies. So these are the technologies that are mission critical to the success of their customers. If you think about a car, the linchpin is in the axle. And if you pull the linchpin, the wheel will fall off. I want to find the companies that sell that pin that is absolutely mission critical. And a couple of examples would be companies like TSMC or NVIDIA or ASML. Those are great linchpin companies. The second, they should be innovating in secular growth markets. So that means taking share in fast growing end markets. Take an example, the AI chip market is going from $45 billion last year to $400 billion by 2027. It's a 70% CAGR, really one of the fastest growing end markets I've ever seen. So we don't buy companies that sell lifeboats to sinking ships. We want to buy healthy companies that sell into healthy end markets. The third is you want to make sure you have improving fundamentals. And so that's revenue that's accelerating, operating margins that are expanding, or free cash flow conversion that's improving. And then finally, you want to make sure you have a reasonable valuation. In technology, if you pay too much, you can't compound your returns. And often the very cheap stocks have a problem. Something's wrong with them, and they may be value traps. And so what I would tell everyone who's investing is they have to have a framework that fits their style, fits their personality. And then the third thing, you want to try to be balanced in your approach. We really try to be balanced between hardware, software, internet payments, small cap, mid cap, large cap, mega cap, the US, Europe, and Asia. And with that foundation and portfolio construction theory, we could try to navigate the volatility. So those would be the three things I'd say. Do your homework, have a framework, be balanced in your approach.
For those of us who can stomach it, let's say, right, the less risk averse and want to go into more opportunistic acquisitions, maybe. We had to talk about AI though, because there's a lot of negative rhetoric coming out, narrative surrounding AI, how much energy it uses and such. So if maybe I were a tree hugger, I'm not so interested, I wouldn't be so interested in it. So talk to us about what all of this rhetoric and AI advancement means for tech stocks.
Yeah, there's two big questions around AI. Number one, is there any return on investment for the hyperscalers? They're spending all this money. Are they going to earn any money from it? And then two, what are the environmental impacts? What are the worldwide impacts? What are the societal impacts of AI? Another term for productivity is companies are going to get leaner. And what does that mean too? So I'll start with your first question, which is the environment. I actually think AI is going to accelerate our path to a more sustainable economy. And I know that sounds counterintuitive, but these companies are very, very focused on keeping their green envelope in check as they build out their power. And what's happened, particularly in the US historically, is we haven't added much power to our overall grid in a long time. Overall electricity consumption has actually been relatively flat. There's really been no incentive for the power companies to go invest in new green technology because you're kind of just going from one hand to the other. But what's happening with AI now is electricity consumption is going to go up. And the hyperscalers are actually very focused on having a net neutral power consumption over the long term. And so that's why we see things like Microsoft working with Constellation Energy Group to return on nuclear power plants in the US. Because with that, you get really strong, clean baseload power. These hyperscalers are really going to be focused on particularly clean nuclear. Makes a lot of sense for hyperscalers because the issue with nuclear historically is you can't turn the plants off. It's great baseline power, but there's no ability to turn up and down the output. Well, guess what a data center is? Data center is constant consumption of power. So I think these companies are going to work with the power plants to actually result in a more green future. And it's going to give these companies the necessary money to invest. The second big question around AI is return on investment. We're seeing these companies spend tens of billions of dollars. What does that mean for their free cash flow? What does it mean for Microsoft, who's going to spend significant amounts of money, for example? I'm in the camp that there is a return on investment to this spend, and it's actually pretty clear. Number one, let's look at Meta as an example. Meta has gone mid-single digits not that long ago on the top line to over 20% top line growth. A significant portion of that is their ability to use AI to do better ad tracking. Google is consistently growing their search business double digits, despite new competition coming in. That's an example of AI helping them create a stronger advertising environment. Microsoft's cloud revenue would be in the low 20s if they didn't have AI. It's now in the high 20s because of AI. And then finally, I think Apple's actually going to see an upgrade cycle because of AI. In the US, if you look at the carrier numbers, the average person who stays with a network, say Verizon or AT&T, if you stay on the network and you don't switch, because when you switch, you get a new phone in the US, but if you stay on the network, that upgrade cycle has expanded to 8 years, which is an incredibly long time. So much of the installed base needs to upgrade. So I think that AI is going to have a return on investment by accelerating the growth rates of the most profitable companies in history. And then finally, what are the societal impacts of AI? And I would say AI is another software tool. It's not that dissimilar to the way Excel caused some jobs to change in the marketplace. So it's not that dissimilar. But the people who just figure out how to use AI productively will be in a really strong place over time. But it doesn't mean that we're not going to have some friction in the short term. So over the long term, very, very prosperous future. In the short term, there could be some friction, but that's what happens with creative destruction, right? You go through periods of ups and downs, and over time, productivity improves the overall economy.
I'm going to just follow you. The risk averse, lazy, I have no time to keep looking at the charts. What should we be investing in then?
Yeah, look, that's when you can really find a great partner, right, in your investing. And that's why I would really study who is able to have the resources to do the time for you. So when we come and try to understand a company, we're one of the most knowledgeable people on that company because we're specific to, I have analysts in Australia, I have analysts in Japan, I have analysts in Singapore and Hong Kong and London and Baltimore and New York and California, right? And we're all working together to try to figure out, are there any dislocations in the market? So I would really focus on finding the right partner. I think that's really important. And if you can find someone who has a great investment framework, that's also a good place to be.
Dom, thank you so much for your time today.
Thank you so much.
Please get in touch if you have feedback or an episode idea. btpodcasts@sph.com.sg. I'm Howie Lim, and this has been Money Hacks from the Business Times.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.